Good morning, everyone, and welcome to another edition of the Festival of Enterprise webinar series, Bounce Back Live, where we cover topics related to getting people back on track for emerging out of the Covid-19 crisis. My name is David Stevenson. I'm your host, and I'm joined this morning by Mike Stanley from Fluidly. Mike, good morning.
Good morning, Dave. Thank you very much for having me. It's great to be here.
Well, our pleasure. Thank you for joining us. Mike is the lender partnership manager at management at Fluidly, and Mike will be taking us through a presentation this morning on funding outside of Bounce Back loans and the CBILS program, alternatives that people can consider because these programs have been a bit tricky for a lot of people to access, and so he'll be giving some insight into both those programs and equally alternative methods of accessing them or alternative sources of funding. So Mike will take us through a presentation, and then at the end of the session, I will open it up to questions and answers. So with that, Mike, I'll hand it over to you.
Brilliant. Thank you very much. Good morning, everyone. As I said, thank you very much to the Festival of Enterprise for having me. Hopefully I can give some useful insights to the current shape of the lending markets, and hopefully you can clearly see my screen. So without further ado, I'll crack on. So just what I'll be covering today as an introduction to Fluidly, a brief introduction to myself, talking about the current bounce back loans and the CBILS loans, talking about the alternative funding market, looking at what type of customer you are and how you may fit into the alternative market, and talking about why businesses might need funding for your business as well. So very quick introduction to Fluidly. We've been around since 2016, and the aim has always been to support small to medium-sized businesses by helping to manage their cash flow. The idea is we have a intelligent cash flow management tool to give customers better insights to their cash flow and what they may be able to afford, and just generally helping. It's one of the biggest challenges in running any business is their day-to-day cash flow. To date, we've raised over £14 million, which has helped us to invest in the technology that we used and also help us to scale our team. We're connected and working with over hundreds of accounting partners up and down the UK to help us work with those much needed SMEs that need the support. And through them, we're connected with over tens of thousands of SMEs as well to help them grow, manage, and encourage them to run their day-to-day business without any worry. A little bit about myself. I joined Fluidly back in October 2019. I've worked in the SME financing funding sector now for just over a decade. I've worked directly within lenders. I've worked within brokerages before making the move over to Fluidly. And across those 10 years, I've worked within the sales departments, so customer facing, speaking to business owners. I've worked with partnerships, managing key relationships through businesses. And I've also worked within the operational side of the businesses, looking at processes, systems, customer journeys, everything to help the kind of experience for the customers to be as good as it can be. So we kickstart this morning by talking about the current bounce back loans and the coronavirus business interruption loan schemes, also known as CBILS. So the current state of play since COVID-19 forced the UK into a lockdown, the government have released a few schemes to try and help small to medium-sized businesses to help during this pandemic. And the two main avenues they've looked to help is through the bounce back loans, which was recently introduced to the lending scheme. And this was kind of designed because the CBILS scheme was not having the initial success that they were hoping. So the first edition of the CBILS loans was anywhere from, I believe, a couple of £1,000 right up to 5 million. But they wanted to do something to help on the lower side, which is why they brought in the bounce back loans. So they introduced this a couple of weeks ago. So you can borrow from £2,000 up to £50,000. A repayment period of over 6 years with no setup fees. The first 12 months of interest payments are covered by the government, and also no payments for the first 12 months. So as we're going through these challenging times, it's giving those customers peace of mind that they have cash in the bank and try and get back to some trading normality. The second that's been well documented is the CBILS loan scheme. This has obviously now been moved from anything over 50,000 up to 5 million, offering the first 12 months of interest and fees covered by the government. And there's various different types of funding available, such as loans, overdraft, invoice finance, and more. Compare that to the bounce back loans, where it's traditional business loans that are available. And the current state, or how the kind of schemes are looking at the moment. So we've seen a lot of movement since they went live. So to date, there are 16 accredited bounce back loan providers. That was up from the original kind of, I think, 8 or 9 that was, generally speaking, the well-known high street banks. And we've now seen an increase to 65 accredited lenders for CBILS. This number originally started at 40. They've continued to add over the couple of weeks, and we expect more to be added over the coming weeks. And this has been aimed at increasing not only the number of funds that have been lent, but also the number of businesses that are being lent to. As you can see there, the bounce back loan, even though it's been around for a shorter term, has lent almost double the amount that CBILS has. So just over 14 billion has been lent over to just over 460,000 businesses, and the approval rate roughly sits at around 80%. Compared that to the CBILS loans, where it's just been over 7 billion, and just over 40,000 businesses have been successful in applying for a CBILS loan, which means the current approval rate sits at around 50%. So talking to many lenders in the market, we've seen potentially businesses shift from maybe looking at kind of 75 to 100,000, what we would class as a CBILS loan, and potentially looking into the bounce back loan and taking a lower amount. And this is something we'll be talking a little bit more about through the presentation as to why the alternative market that we'll be focusing on today might be useful in those kind of circumstances, and also for those that have not been successful in achieving a CBILS loan. One of the big things to note is the banks, and the majority of banks that have been providing these loans are only seen to be lending to viable businesses. I'm quickly going to break down, and this is kind of my view, and from speaking to various different lenders, what a viable business looks like. So first of all, they're looking at longevity of businesses. They like to see a good trading history. So something typically 6 years or more. It gives them that confidence that the business is, got an established customer base. They should be, kind of hitting their, not necessarily peak, but they should be hitting a good run rate now of turnover and profitability. So it just gives them that securitization in terms of knowledge that the company knows what they're doing. Most businesses unfortunately fail within the first 2 years. So if you're making it to the 6-year mark, you've deemed to have done quite well. They also like to see positive trends. Now this can be a few things, from increase in turnover, increasing profits, managing your cash flow well within your bank statements, or moving further away from maybe an overdraft facility, or moving further away from a zero balance. So anything where it indicates the business is increasing or going in the right way is going to help you in terms of putting you into that bracket of being a viable business. Profit making or consecutive profits. So again, from a banking point of view, to show affordability, they need to see a company that's making profits. So it may prove challenging for those businesses that are loss making or breaking even. But from a viable business point of view, profit making or continuous profit making is a good sign from a banking point of view. I briefly touched on the bank statements, and this is a big part for any lender, because while accounts will tell you what happened typically 9 to 12 months ago, bank statements will be looked at as up to date as possible, so it gives you a much clearer picture of what's going on in the business today. So this will tell lenders in terms of what other debt might be in the business. Are they going over their overdraft limit? Are they going into an unarranged overdraft? Have they missed any payments? So again, anything that looks positively clean, they're making their debt repayments, they're managing their cash well, there's good cash reserves in the bank statements, will all help to build a positive profile for the business. And finally, a strong credit report. And this is both on the business and the directors of the business. And it's a common misconception by business owners that because they're borrowing the money for business, it's only the business that needs to have a strong credit report. The view of a lot of lenders is that while yes, they are lending money to the business, they're also trusting the directors of that business to ensure the business continues to grow and is able to pay that money back. So they want an element of trust in the director who is supporting that loan. So they will look into the history. So anything that might be considered adverse, so missed payments on mortgages, missed payments on other payments, CCJs, previous liquidations, all these things could point towards a weaker credit report. So if you take the point of no missed payments, one business or a couple of businesses that have never gone into administration or been dissolved, all these kind of positive things will again pull you into that bracket of being a viable business. Now, I'm not saying if one of these areas maybe is a bit lower that you're not deemed a viable business. This is just kind of my view from my experience and speaking to lenders that we closely work with to kind of ascertain what a viable business might look like. So the big question when speaking to a lot of customers now is, what can they do if they're not able to get a bounce back loan or a CBILS loan, or if they just can't get enough through either of these schemes? And what are your options? So my background is in the alternative market. As I said, I've worked within lenders and brokerages. So hopefully I've got a bit of knowledge in terms of what the alternative market can offer. And it's a kind of exactly what it says. It's an alternative option. It's an alternative view for business owners. And typically when the banks, pre-COVID and post-COVID have been unable to lend or support, and the alternative market has been able to help customers that have not been successful with their banking partners. And in the recent weeks, as well as the CBILS accredited lenders, we've seen more of those alternative lenders added to kind of support those banks. So some household names like Funding Circle, iWalker, Close Brothers Asset Finance, Bibby Financial Services, Market Finance, and more. There's more being added every week. I imagine for the next couple of weeks, speaking to our lending partners here from Fluidly, every pretty much lender that we know has applied to be accredited as part of the CBILS scheme. So there'll be more options available over the coming weeks. So if you have been unsuccessful with a CBILS application through your bank, then it's worth looking at some of the recent accredited lenders on the CBILS scheme in the alternative market. So as I said, alternative lenders will tend to have an alternative view. So while you might have marginal profits, you might be breaking even, you might have reduced a small loss, there might be some adverse information on your credit profile, it's not necessarily going to turn away lenders from the alternative market. They've got more flexible underwriting. The good thing as well is quicker decision times. So again, stories of speaking to customers of the challenges sometimes of applying through their bank is, they need a quick decision to kind of crack on with their business, or they've spotted an opportunity which funding would help them realize. Typically speaking, in the alternative market, you're looking at a decision within 2 to 3 days, and once approved, funds can be drawn down within a day or two, and funds deposited within an account within 24 hours of signing documentation. So it really can be a quick turnaround, which sometimes is more appealing than actually going direct to your bank, knowing that you're going to get a quicker decision. Some of the other appeals working with the alternative lenders is less documentation. So generally speaking, last set of accounts and last 3 months bank statements will tend to be all you need to apply with a alternative lender. And often, limited security is needed as well. So typically speaking, with a lot of the alternative providers, you may only need to require to give a personal guarantee. There are lenders that don't require a personal guarantee. They may be able to take a debenture of the business in replace of that. But the options are wide and far within the alternative market. And while your bank may offer a couple of products, within the alternative market, there's a wide range of products that you may not have thought of, but might actually be suitable for your business and your day-to-day running. So currently within the alternative market, there's roughly over 300 lenders across the market. As I said, there's multiple products, your typical business loans, invoice finance, selective and single invoice financing, asset finance, refinance, trade finance, merchant cash advance. I'll cover some of these products very shortly, but the options really are available. And through these lenders, you can actually get some bespoke offerings. So it's more, the lenders will kind of talk to you and understand your position and try and put something to you that might actually work around your situation. And that's the same set, specialist lenders for your needs. So depending on kind of your requirements, no business, their needs are going to be different. Across hopefully 300 lenders, there should be a lender to kind of suit your kind of need. So a breakdown of the alternative lending market. So what types of funding is available? So you've got kind of two categories I like to class it as: your unsecured lending, which is your typical loans, flexible overdrafts, or revolving credit facilities, and merchant cash advance, which is a bit of a niche product I'll discuss in a little moment. And then we have what you call your typically asset-backed lending, and that will be your invoice finance, asset finance, secured loans. So I'm going to have a quick breakdown now. So covering off the first one being business loans. This is a very well-known product to most businesses. You borrow X amount, you have an agreed monthly payment, and you have an agreed amount that you pay back. So the question really, across the alternative market, who is eligible? Now, within different lenders have different criteria. Some lenders will need 6 months trading time, some 12 months, some 24 months. Essentially, I would say, roughly, if you've been trading 6 months and you can show revenue coming to the business, that you'll have an option for a business loan. When would you use a business loan? It's typically used for a wide range of different types of reasons: growth, managing cash flow, purchasing top stock, taking on new staff members, or fulfilling a new contract. The limits are kind of endless with a business loan. How do you access it? So again, there are many lenders across the market. There are partners like ourselves that work with these lenders, and typically speaking, limited information needed to be provided, such as accounts, bank statements, and we'll hopefully be able to get a decision within one of our lenders within about 2 days. And that kind of brings me to that last point in terms of how quickly can you access these funds. So 2 days is the kind of typical time for a decision. Documentation can be raised the same day as an approval. Once signed, you're looking at kind of a 24-hour turnaround. And in between, I will always stress, there's a chance where lenders may come back and ask for a little bit more information or a few questions. But typically speaking, 5 to 7 days is a good turnaround time in the alternative market. It also helps businesses kind of know pretty much straight away where they're at, because they want to focus on their business. They want to know if they can access those funds, which allows them to continue with their plans. So flexible overdrafts. So a banking overdraft is actually quite a unique product. You can kind of sit in it for forever and a day, paying interest on it. Within the alternative market, there are what we'd call flexible overdraft or revolving credit facilities. And these are typically kind of short-term 12-month facilities, but it just allows kind of that additional kind of piggy bank for you to kind of dip into as and when you need. And you can have a 50 grand facility arranged for you. You then only kind of pay for what you use. So you may only need to borrow 20 grand. So rather than maybe taking out a business loan over an agreed amount, you may only need to buy some stock that month, dip into your kind of flexible overdraft, sell the stock, and you'll pay it off after a couple of months, and then you're back to a zero balance and kind of not paying anything. So we see a lot of businesses opt for this type of facility because not necessarily they don't need all the money in one hit. And again, stressing you only have to pay for what you use for. So when would you use it? I think I gave an example there. Businesses buying stock. Retail stores will often kind of have to do a monthly or every few weeks rebuy their stock. So it's good for kind of ongoing costs. Some businesses like to use it for kind of HMRC bills. Any kind of ongoing cost is quite useful in terms of using a flexible overdraft. Again, how do you access it? There's lenders out there that offer these facilities. Fluidly itself works with these as well, so we can help with pointing you in the right direction. And similar to a business loan, you're looking at decision time of kind of 2 days, and funds can be in your account typically within 5 to 7 days of application. Now, merchant cash advance, it's something you may have never come across. You may have. It's quite a niche product. Who is eligible? Now, this product is typically designed at the retail, hospitality, and leisure sectors. It's designed for companies that are taking card payments. And what they will do, they will lend you money against your card sales. So they'll look at the last 12 months of revenue you've taken through your card machine and typically lend you anywhere between 1 to 2 months of your card takings. And what they'll do every time they'll register a split on your card terminal. So every time there's a transaction, they'll take a percentage of your sales. So for example, if they take 10% and you have £10 sale, £1 will go to take off your debt, and the other £9 will go back into your cash balance. When would you use this type of facility? So a lot of businesses will use this when they're maybe looking at refurbishments, again, helping with buying stock, additional cash flow into the business if they're about to go into their busy or quiet periods. So again, there's a wide range of reasons why someone might look to use this product. And again, there are, in terms of accessing it, there are specialist lenders within the market that provide this facility. It is a niche product, so there are specialist lenders out there. And again, Fluidly has access to these lending partners that we can help point you in the right direction. In terms of how quickly can you access these funds, this one does take a little bit longer. Typically takes about 2 weeks to set up a facility. The delay on this is purely down to the card terminal provider, typically taking kind of 10 to 14 days to register that split before the lender can release funds, because they need to know that once payments are being made, they get their money back. And moving on to kind of more asset-backed lending, it's a facility that's been around for a very long time, which is invoice finance. Who is eligible? Typically any business that is trading with other businesses, what we call B2B. So you might be a manufacturing business, selling or providing parts or making parts that are then being sold to Airbus or somebody like that. They may put you on a 90-day payment term period. Therefore, an invoice finance facility would help kind of give you that cash in the bank on day one rather than waiting 90 days, because if you've got multiple invoices, you could have a couple of $100,000 that's outstanding. So therefore, invoice finance is a great way of keeping cash in the business. And that really covers kind of when would you use it. A lot of these businesses can't wait 60, 90, 120 days to have money back in the business. So by raising the invoice on day one, they can take that to their banking partner and get up to 90% of the invoice value on day one, keeping that cash in the business. Typically speaking, you can access this through, your banks will offer this facility, but it may also be worth looking at the alternative market, because they may be able to offer maybe better rates. They may be able to offer more against your invoice. And in terms of the process might be, you might find a relationship might be more suitable for you working with an alternative lender. So how quickly can you access these funds? It can take a couple of weeks to complete this, because the lenders will need to do their due diligence, they'll need to do their underwriting, they'll need to kind of authenticate the invoices and make sure everything is above board. You'd probably be looking at about 1 month for this kind of be completed. There are lenders that can do it quicker. But typically speaking, what we find with businesses is they'll be speaking to a few invoice finance providers to make sure, as I said, they're getting a lender that for them provides the best service, possibly the better rate, or even providing a higher percentage amount against their invoice. Another well-known facility asset. Typically any business that is looking to purchase a piece of equipment, machinery, vehicles, office equipment will be viable for asset finance. There's a common myth that you can only finance hard assets, and by hard I mean, like I said, machinery, construction equipment, tools, vehicles. But for restaurants, offices, you can actually fund tables, chairs, TV screens, phone systems. And there are specialist lenders that provide what we would call soft asset funding. When would you use it? So depending on what you might need. So if you're buying an asset, or even potentially if you've got existing hard assets within the business, you can actually use. Maybe a case you use it when you buy something, or when you might want to use existing assets and the money to raise funding for cash flow, restructuring the business, helping buying other equipment as well. So there's plenty of options when you might use asset finance within the business. How do you access it? Again, it's a facility probably offered by your bank, but there are a large number of alternative lenders that might be offer a bespoke offering to the business to suit your needs. And typically speaking, this does take a little bit longer than a loan. You're looking probably a couple of weeks, and the delay might be with a supplier until the goods have been supplied. Typically speaking, the asset finance now before paying the funds to the supplier, because they won't pay the money directly to the customer, they'll pay the money direct to the supplier. So if your supplier's got the goods there and then, it can probably speed up the process. But just something to bear in mind, if your supplier may take 2 or 3 months to get those goods in, it could take a little while. So if you are thinking about buying goods, it's good to know how quickly you can get them from your supplier. Secured loans, this kind of covers a wide range of typical type of lending, but secured loans essentially against property, and that can be residential or commercial. There are lenders out there that can lend against your debtor book, which is money that's owed to you by other businesses, and there are specialist lenders that can lend against stock, which can get a little bit specialist lenders out there. So when would you use a secured loan? I suppose over a business loan. There's a few examples. Maybe if you're looking for a larger amount, typically over maybe £250,000, you may want to look at offering or looking into secured loans to kind of achieve that. If you're looking maybe for a longer term, typically speaking, business loans will only tend to extend up to 5 years. By offering a security, you can take a loan of anywhere above 5 years, 10 years, in some cases longer. So again, it kind of comes down to how low do you maybe want to get your monthly payments, but how comfortable are you spreading the cost for as well. Again, accessing it, your banks may be able to fulfill this. But again, it will come back down to the bank's affordability model. And this is where we see a lot of people dipping into the alternative market. The alternative lenders that will look at maybe the security you're offering, rather than maybe actually looking at the financials of the business to actually secure the funding for you. The quickness of the access to these funds, this typically takes about 4 to 6 weeks, given the nature of using security. Solicitors need to be involved to make sure they're registering a charge. If there's other security that's being used, they need to do their due diligence. So typically speaking, it can always be quicker, but I would suggest anywhere between 4 to 6 weeks. I've said this, there are, with over 300 lenders in the market, there's lenders for all different types of scenarios, business for long-term trading businesses, loss-making businesses, challenging backgrounds. I'm going to run through now kind of, I suppose, a tiering system, because it's important for you to kind of understand sometimes where you might sit and what options might still be available for you. So altogether there are 3 tiers. So we would class kind of a tier 1 application as a long established business. So talking about that maybe 6 years or more, positive trends within the business and a strong credit profile, meaning like no missed payments, no arrears, a very clean, always up to date on payments, kind of credit profile will help kind of cement you into a tier 1. Tier 2, is an established business, probably looking kind of like 3 to 5 years, modest profits, you are making profits, but maybe below kind of the industry standard margin, and what we would call a clean credit profile. So there may have been a few blips, there may have been a few missed payments in the past, but you've caught up to date. So why may not be classed as a strong credit profile, but you do have a clean credit profile because there's nothing serious on the profile as of today. And then what we class as a tier 3, a short-term trading business, anything typically probably below 2 years, loss-making businesses, or companies and directors with adverse information. So that could be missed payments, CCJs, whether that's active or satisfied CCJs, previous liquidations. I suppose the good thing about all these scenarios are the alternative lenders, they're manual underwriters, they will talk to you. So even if you fell into a tier 3, not to say there are options still available to you. So I speak to a lot of businesses who've said to me, I've got an active CCJ. It's understanding kind of what's driven that and kind of what's happened. If it's a £100 CCJ, there's actually a good chance the lender will just kind of overlook that. But if there's a £5,000 CCJ and it's possibly in dispute, again, the lender will want to understand what's going on. So I want you to take away, maybe, if you do think maybe you fall into a tier scenario, these businesses, by potentially lending that money to grow your business, help to make you more profitable, get you back on that road to slowly climb that ladder and potentially get to a tier 1 customer. So one of the big questions at the moment is kind of borrowing during and after COVID-19, the kind of lockdown situation that we're in. So there will come a time or a moment, and I'm sure we'll be very grateful when the world gets back to normal. Obviously, the positive news from yesterday is, on the 15th of June, that shops can start to reopen, all being well, once the tests have been done. But it looks like we're getting slowly back into a bit of normality, although it may be challenging in the early months, kind of still keeping social distancing. But the biggest challenge now in post COVID-19 lockdown will be for business getting in the business or keeping cash in the business. So we often get a lot of business trying to understand what reasons can they borrow for. What is a viable business borrowing reason? Is a wide range of reasons why you can lend. There's almost any practical business reason you can lend, but I just thought I'd quickly take you through some of the main reasons as to why businesses borrow. And often business owners are scared to borrow for cash flow because they worry the lender might have that. And the truth of the matter is, in the alternative market, what we call working capital cash flow loans are probably the kind of biggest reasons why a lot of businesses borrow, and lenders are very comfortable with that. They understand the challenges of day-to-day running of a business. Cash flow is king, as they say. So the idea of cash flow is keeping that cash in the business, helping with ongoing costs, and that could be staff costs, buying new material, buying new purchases, helping with steady growth, covering a wide range of things. But if you are looking for cash flow funding, then absolutely, the alternative market is a good place to turn, with plenty of options for you to consider. Obviously, one of the other big ones is growth. A lot of businesses have aspiration to grow from the year before, and this could be anything from buying new equipment to fulfill a new contract, or replacing existing equipment to kind of speed up the process. Taking on new staff. Any business that grows, will need to bring in new people to help with that expansion. And obviously, most businesses will continue to purchase new stock, but as you grow and scale, that need to buy more stock can suddenly become, a costly experience. So again, borrowing money for purchasing, any of these kind of areas is definitely a formidable reason within the alternative market. A lot of people I speak to kind of get sometimes their back up a little bit when I talk about VAT and tax. There's an old stance of, if I can't afford to pay for it, why would I borrow it? But a lot of businesses will actually borrow money for their VAT and tax just to purely split the cost and kind of keep that cash flow within the business. Businesses out there will have a 40 grand quarterly VAT bill, and that's a lot of money to have ripped out of their cash flow. So there are lenders out there that can help spread the cost over a couple of months, and it just helps them kind of manage that cash flow day to day. So they actually use it as a cash flow management tool. Same with the corporation tax, spreading the cost over 12 to 18 months, potentially longer with some lenders, just helps them kind of keep tight on their cash flow management. And obviously, as you're scaling, you may come across, unexpected larger bills, which can sometimes be the downside of doing quite well within the business. You're suddenly hit with a larger than expected. You're jumping from 40 to 60 grand. You may need to borrow some additional funding to cover that cost, because there's a chance you may not have put money away for it. But absolutely, VAT and tax again is a reasonable request with any alternative lender. And one of the other big ones we see is refinancing of debt. Businesses, especially as they're growing in the early stages, may take out multiple products from lenders to help their cash flow, help their growth plans, and they'll have multiple payments. So what they like to do is kind of have one monthly payment going out, which is where they turn to a lender to consolidate all their payments into one monthly easy manageable payment. In some cases, they may have taken on higher interest loans as they were in their early days, but now they've become an established business. They potentially qualify for better rates and maybe longer term products. So by restructuring it, they can actually reduce their outgoing costs. And with these impacts, it just again helps to manage their cash flow. We've seen businesses where we've been able to save them 10 grand a month on their outgoing costs. It's 120 grand a year. It just helps them manage that cash flow and use that cash then to go and invest in other parts of their business. I suppose the big things to think about before borrowing. Do you really need to borrow? It can sometimes be an easy decision to make to go and borrow money, but sometimes it's worth looking at. Do you need to kind of borrow the money? Because obviously, with borrowing money, there is going to be a cost involved. If you're putting security on the line, you've got other things to think about. So just have a really detailed think. Do you need as much as you think you do? Could you maybe borrow less? But definitely something to think about. Are you prepared to offer a personal guarantee? So a lot of the alternative market will ask you to provide a personal guarantee. The agreement between the lender and the director that they'll keep up to date with all payments, and also to make sure they'll pay the outstanding balance back over time. But are you comfortable having that liability over your head? I suppose. Only you will know the answer to that. But if you trust yourself, if you back your business, there shouldn't really be too much of a challenge of signing a personal guarantee. But from a lender's point of view, it just hopefully focuses the director to make sure they're keeping on top of their payments and their commitment to the lender. I've seen a lot of customers fall into this trap, not sure which lender they need to approach, so they approach many lenders. But applying with too many lenders could potentially have an effect on your credit score and hamper your potential to borrow at a future date. So typically speaking, if you approach one or two lenders, this is not going to have a detrimental impact on your credit score. And a lot of lenders now will carry out kind of soft credit searches, so not too impactful. But there are lenders that will still carry out what we call a hard search, which will leave an imprint and potentially a minor impact. But multiple hard searches will suddenly have a larger impact and may affect your ability to borrow in the future. And because alternative lenders are, as I said, taking alternative views, they're taking on maybe more challenging cases. The rates are likely going to be higher. So this comes back to, I suppose, my first point: do you need to borrow? Because with a slightly higher interest rate, for example, it's going to eat more into your possible margins on your profit. So again, something to think about. But I suppose if you're borrowing, let's say £50,000, and you're paying back 65, but you're going to make double that in profit and cover the costs, it may be seen as a worthwhile investment. Whereas if you're borrowing 50 and paying 65 back, for example, but only making 5 or 10 grand profit, where you could have made more potentially, again, it's just something worth thinking about. And my last note here is sometimes I think people don't understand possibly how big the alternative market is, but it's been responsible for over 8 billion of funding to UK SMEs pretty much for the last couple of years, and that's forever growing as more businesses require additional funding outside of traditional bank funding. And finally, I'm going to talk about how it's Fluidly helping business owners. So I talked at the top that we provide helpful insights, intelligent cash flow management tools, to give you insights to kind of your day-to-day running, kind of give you an indication of potentially you might potentially hit a bump in the road in a few months. Also help you in terms of identifying if you've got any invoices outstanding, who potentially owes you money, and it's also got some cool features that we're adding, such as goal planning. So if you are planning on spending money, you can attribute that into your cost of Fluidly, to help you kind of manage kind of how much you need to put away and how much you need to spend going forward. So lots of useful tools for business owners to kind of help the day-to-day running of the business. And we are working now with a wide range of banking partners, alternative lending partners, CBILS accredited partners, to provide funding solutions for our customers as well. So we provided a new page on our website, and all you need to do to kind of give you an indication of what's available is jump onto our website. You'll see a funding tab. If you simply type your business name in, we'll be able to pull information that's available publicly to kind of give you an indication to what options are available to you, and hopefully give you kind of a guide to the term and the total payback amount. So without actually having to go through a full application, it just gives you an idea. And we do have funding experts that you can speak to, because no scenario is going to be the same. So if you have any additional questions after looking at your options, we are on help to hand. And I hope that's been really helpful. I can see the questions coming through, so we'll jump onto the Q&A, but hopefully I've given some good insights into the alternative market, and potentially answered some questions that might be at the back of your mind. But thank you for listening.
Mike, that's very kind. That was incredibly helpful, and I'm sure has brought up a lot of questions. Well, it certainly has. We definitely have some questions, but provided food for thought for a lot of businesses that may not have considered this avenue towards obtaining financing. So I see your colleague James has been online helpfully sort of answering some of the questions. And we do have some other ones if you have time to go through some of them.
Absolutely.
Great. I mean, something you've really spoken to already, but Alan is saying that 90% of the banks are providing only CBILS or bounce back loans to current customers, even when they're saying they'll work with new customers way down the list. So, I mean, what options are available? I mean, should they go directly to alternative finance in this instance, or stick with their banks and just wait? Or
I mean, I suppose I've talked about this a lot on other forums. Plan A and Plan B. Plan A would probably always, and especially in the current pandemic, Plan A would be to get funding through your bank, if you can. But there's no harm in actually, what we've seen in the past, people go for Plan A, wait, maybe not get the successful decision they want, and then move on to Plan B, which may be the alternative market. Obviously, right now, speed and peace of mind is the biggest thing. There is nothing, to stop you. And I talked about it before. Obviously, having multiple searches, so be very careful about how you do this. But there's nothing to stop you from going to your bank and potentially looking at maybe one or other alternative option at the same time. So you can have two applications in parallel. You can't have two CBILS loans at once, but you can have two applications in the process. And you may still get an offer maybe from an alternative market, but you may then still want to wait to decide to see if your bank comes through. So the challenge for the banks, and I do feel for them, they're obviously getting a bit of a hard time, but I think any business that would deal with the increased percentage of customers applying for a product are always going to face problems, which is why we're seeing more accredited lenders, especially from the alternative market. But it's definitely well worth looking at Plan A and Plan B at the same time. As I said, you may get the offer from Plan B, and maybe a week later you might get the offer from Plan A, which you would probably likely move with Plan A. But it's that whole thing about being kind of in control, rather than waiting potentially longer to get a decision from Plan A. The alternative market is Plan B, might be able to get a quicker decision, and you may decide to kind of push through with that just to get that money in the bank account and allow you to kind of move on as quickly as possible.
I think that's good advice and makes a lot of sense. Thanks, Mike. We have a question here from Mr. doesn't say the name, okay, but they're wondering if they already have a bounce back loan, and they're wondering if they can apply for the CBILS to replace the bounce back loan. Now, I know that the opposite is true. If you had a CBILS less than 50,000, you could turn it into a bounce back loan. Can you go the other way around if you need more financing?
You can. I think the important thing to remember, you can only have one or the other. You can only have a CBILS loan or a bounce back loan. Obviously, the decision will come down to the bank ultimately, or the provider. If they're happy to provide a CBILS loan, they will settle off the outstanding balance. But yes, you can go the other way.
Great, thank you for that. Phil is concerned about the scheme running out of money. Wondering if the bounce back loans scheme will run. Is it likely the bounce back loans will run out before my bank is accredited? Is there only a certain amount allocated to each bank?
So typically speaking, yes, each provider does have a set amount, but it's likely those accredited lenders, if they're successfully fulfilling their, I suppose, commitment to the British Business Bank and providing that funding, it's likely as they will get extended in terms of the amount that they can lend. So let's say, for example, one bank was given 100 million and they're getting to 80 or 90 million lent, but still are showing demand or need for that product. I think it's very likely the British Business Bank would allocate more funding for them. So I would say that the likelihood of the scheme running out in the short term is quite low.
Okay. Good to know. And there is a time limit on this on the schemes in general. If I'm not mistaken, it's September that they are currently allocated to.
I believe so, but we've seen obviously the furlough scheme pushed back into October, and I think depending on what happens, they're going to be the hospitality sector, particularly, is probably going to be the last phase to open. So I think it's kind of a date in the diary. I'd be surprised if that was a hard stance, and it's likely it may be a case of sector by sector that certain dates will be stopped lent to. So I know manufacturing or construction that are probably being encouraged to go back to work may struggle to get this type of funding in a little while, whereas hospitality may run later into the year. I mean, that's just kind of my personal opinion rather than fact.
Thanks, Mike. That sort of segues nicely into a question we were speaking a bit about before the webinar began. And there's a question here from Michael wondering, does anyone know if the hospitality businesses are being granted CBILS loans given they are closed?
So they are. I think the challenge really is kind of for hospitality is to kind of show that their affordability in trading during this time. So there are businesses that have often been able to pivot during lockdown. So kind of restaurants are starting doing takeaway food or deliveries. Obviously, there are hospitality that has been struggling, which again, why we're probably seeing more accredited lenders on the alternative market to kind of help those that have not been successful through their bank, because maybe the bank's kind of underwriting criteria may have deemed to be too strict. So the alternative market providers will probably be able to help those that have been unsuccessful. Obviously, they're not going to be able to help everyone. I've talked about the viable businesses. I would love to sit here and say everyone's going to get a loan or a facility. It may be a case of maybe not a loan, but other facilities might be able to help.
Great. Thanks, Mike. So Phil, worth checking out the alternative market. I think if you are, Michael, whether not getting help with your banks, there certainly is financing for the hospitality sector. Stephen is asking, we're a charity and a limited company. As part of our trading activities raising funds, we have a dedicated fundraising team. Does this count towards our 50% trading activity?
I suppose the big question there is kind of how is that revenue reported into the accounts? I think anything that goes officially into the turnover, as long as 50% of it is trading within the UK, then it can be attributed to your financials. And that's the big thing. If it's reported on your P&L and into your turnover, then yes. If it's not, then likelihood no. It just all depends on how it's kind of represented in the accounts.
Sure. Thanks, Mike. So the next question is from Peter, who has a bounce back loan, but it is not enough. I'm wondering if they can apply for more, or is the 20% of turnover a fixed fee?
So I believe it might be 25%, but again, it also comes down to the, I suppose, the risk element. So he wouldn't be able to take another bounce back loan. I think you can only have one. So this is where, you know, we're seeing a lot of businesses divert out into the alternative markets as a top up, because then they're not applying the rules of bounce back criteria. They're just applying then their own internal rules of maybe profitability, X amount against turnover, affordability within bank statements. So yes, if you need funding, there are other options, but you may not be able to get it through.
Mike, sorry, you just cut out there.
Sorry, I'll repeat my answer to that just to make sure I didn't miss anything. So I think I said, in terms of, I think it's around about 25% of turnover on the bounce back loan. So, you know, he may have been lent maybe the max of his turnover or the max they were most comfortable with. So we're seeing a lot of businesses now into the alternative market to kind of top up what they need. So, you know, if they got offered 20 grand, but they needed 40, you know, you can reach out into the alternative market lending to kind of apply for that additional 20 grand, because they're not applying the same criteria that the bounce back and CBILS are. It'll just be underwritten on the lender's own criteria and underwriting policies.
Great, thanks, Mike. Sorry, let's get up to speed with the questions because your colleague has done a very good job of answering quite a few. So,
thank you, James.
Michael is, I have hospitality clients and need some advice on how to help them. I suppose that's potentially from a advisory standpoint, looking to advise them on what funding to raise.
Yeah, I mean, obviously we can talk about what is available. You know, as an FCA regulated business, we have to be very careful in terms of advice. We can't be seen to push a customer down one avenue of funding because it may feel right, but it may not actually be the right thing for them. So we can talk about the options, the pros, the cons, you know, how it will look. Ultimately, the decision would have to come from the business owner. So we can advise on what options are available. We wouldn't be able to advise on what to do for say. So we have to be very careful about that as an FCA regulated business.
No, of course. Yes, my colleague is very much on it, which is good. So I think you know, a lot of people have got answers to a lot of these questions, so I wasn't able to stay up to speed with it. Yes, Alan is mentioning worried about your mention of credit scores from making a lot of applications.
Yeah.
I think a lot of people will. I mean, I think people are aware that hard credit checks do have an effect on your score, which is always struck me as slightly odd. Obviously, applying for credit then affects you negatively, which can create a sort of vicious cycle. But that is the way the scheme works, and that's just people have to deal with.
Again, I think, you know, lenders, you know, have an open mind. You know, if they see application within the last 6 months, you know, that's quite normal for a business. That's not going to defer them from then looking at an application. You know, I think when it comes down to seeing 7 or 8 years within this, it kind of sends a message to the lender, you know, in terms of, I suppose, you know, the requirement is quite urgent, quite frantic. You know, does this business need funding just for growth, or does this business need money to kind of stay alive and keep going? So, you know, there's nothing wrong with having the, you know, a credit search here and there over time. I think it's the amount of credit searches in this space of time which could have a detrimental impact to the business.
Okay. Thank you for that, Mike. Michael is asking a question here, which I think the answer to is no, but wondering about refinancing of existing debt, using a CBILS for that. My understanding is it's not.
No, I mean the idea of CBILS loans are, for those who've been impacted during the current, pandemic. My belief is, it's not doable. Things again may change over the coming weeks, but as of right now, the funding is kind of designed to kind of keep the business going, not to put the business in a more preferable position. It's kind of like a loophole. You're paying interest and probably have some type of PG commitment to the loan. You're using the bounce back or CBILS loan to kind of get no payments and free interest for a year. Good-natured idea of the scheme.
Of course. Good. Well, Mike, I think your colleague has been very helpfully answering a lot of these questions throughout and providing people with access to how to contact Fluidly. So I just want to confirm with you the easiest way to get in touch with Fluidly is to go to the website, which is fluidly.com/funding/ is that correct?
Yeah, that's correct. And then it's very quick and easy. Simply entering your business name. We'll just kind of give you a quick overview of what options are available. And then my colleague James and myself, we're available to have a bit more of an in-depth chat. And again, by that point, there's no kind of commitment to take any application forward. We're not carrying out credit searches of that, because we don't have that capability right now. So it is purely based on public information. So there's no harm with checking now, checking in a couple of months' time. We talked about obviously the impact of credit scoring. We don't do it, so it's not going to have any impact. But it's a great way to kind of see what's available for you in the market. But also we may have some options, behind the scene that hasn't connected through our system as well.
Great. Well, we are. We're getting close to the end of the hour here. We have another question coming from Alan, which I'll just put to you quickly if you have a second. I'm on your website. You can see 6 potential lenders. With respect to his earlier point about the negative effect on credit scores, who do I go to first based on the issue of credit scores? How do you choose?
So our process at the moment is, for example, Alan, if you're on our website, looking at your options, I would suggest clicking on the one that is appealing to you. That will then pass your details over to my colleague James, who will be in touch. And then we can have a bit more of an in-depth chat in terms of kind of what your position is. And it may be a case that lender is correct for you, or we may be able to steer you to a better option, or again, understanding your position, we might have another solution for you. So, there is that kind of human interaction as well. So it's not a case of clicking and off you go. We want to get there in the future, but right now, there's still an element of human interaction.
Excellent. Well, Mike, that's very kind. Thank you, and obviously James as well for taking the time this morning to explain that to everyone. I know that everyone is, there's been a lot of interest. I think a lot of people are struggling to understand the complexities of the scheme, why they haven't been able to access any funding. I know it's frustrating for a lot of businesses, so I'm sure that there is a lot of interest in contacting Fluidly and seeing if they can get some help and do it in a sort of faster fashion.
Absolutely. Our dream is to help business owners sleep better at night. I'm sure there's been a few sleepless nights over the last couple of months, and we're here to help as many people as possible. So thank you for your time. Thank you for having me on, and big thank you to the Festival Enterprise for promoting it. It's been good fun, and hopefully I'll see you again in the future.
Excellent. Well, thank you very much also, Mike. Thanks everyone for joining us this morning, and lots of messages of thanks coming through. So stay safe everyone, and see you soon.
Thank you very much. Bye.